Good morning, ladies and gentlemen, and welcome to the KINOVO PLC interim results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it's appropriate to do so on the Investor Meet Company platform. Before we begin, I would like to submit the following poll, which will just appear on your screens now. And I would now like to hand you over to the executive management team from KINOVO PLC. David, good morning, sir.
Good morning, and thank you very much for passing that on. Good morning, everybody, and thank you to those who have dialed in live for taking the time out to listen to us in terms of the half-year presentation for the period ending 30th of September 2023. In terms of the agenda, we'll follow a sort of route that we followed on the full year results. We'll go through financial highlights, we'll go through operational highlights. Clive will provide a financial summary for the business. And then I want to revert back to the initiatives that we look to drive and execute within our growth strategy, namely accelerate organic growth, improve our collaborative support functions, invest in people in our communities, expand our core competencies, and consolidate our geographic position. I think it's important for us to demonstrate that in terms of the strategy, the initiatives, and the respective execution, that this is evident in terms of our work. So we'll cover elements towards that, and then we'll summarize with a quick outlook before we go into Q&A. So if I pass over to Clive Lovett, Group FD. Clive, financial highlights.
Okay. Good morning, everyone. Yeah, very much highlights as well. There are some further slides to come, so I'll just go through these fairly quickly, but just to really highlight out the initial points. And I think the first one is our EBITDA position, 21% up year on year at 2.9 million. So very pleased with that strong results coming through. As we'll see a little bit later, it's very much driven by our electrical division in that period, which is our highest margin as well. And I think that leads through to revenues are up 2%, but we're seeing margins have gone up quite substantially. We're up almost 2 percentage points at gross profit level. And that again comes back to, I think, the mix that we've got there. And we'll talk a little bit about that in future slides as well. But driven by that electrical division, which has generally been higher margin, and a little bit of additional margin within that division as well. In terms of going down the profit and loss account, the percentages increase, operating profit up 46%, and EPS up a comparable amount as well. And that's really driven, as we'll see later as well, by a reduction in our non-underlying. So in terms of what we have in non-underlying now, it's almost nil. We just have a share-based payment charge that's in there. So historically we had substantially higher numbers. So that's driven the lower end of the P&L. Cash has been strong, 92% cash conversion. We'll talk a little bit about that as well. And we had net cash of 1 million, which is a comparable position to the year-end position that we had, and obviously about £1 million up on the 12-month period since last half year. Visible revenues, which I think hopefully people know how we measure those, and we look at those. We look at it over a 3-year period. It's related to contract values, but also run rates as well that we see as businesses are established or new contracts are established in the business. And we've seen that go up from 146 at the year end to 157 now. So a good increase in that. Again, if I reference more slides to come, we'll see some of the more granular detail in terms of the direct awards that have been won, that have been sort of contributing into those numbers. 95% of those revenues are recurring in terms of that they are contractual revenues. And what we're seeing is 66 million of that number is actually what we're expecting to report within the FY24 numbers, the full year numbers when they come out. Guidance on that is a little bit above the 66. So that is what is visible at the moment and not actually what we're expecting to report for the year. But so you can see that we are substantially on the way there to having achieved our expected revenue position at the end of the financial year.
Thank you, Clive. If we move on to operational highlights, as Clive's already said, in terms of generously profitable set of numbers for the first half year, driven by a favourable mix of works, our ongoing operational efficiencies that we have been running through the business, as well as lower non-underlying costs. In terms of the three pillars, regulation, regeneration, and renewables, the regulation attributable revenues for the group increased to 61% from 54% last year, driven, as we previously alluded, by some of these legislation changes, and predominantly part and parcel of that Building Safety Act, which comes into force in April 24. Within the regulation revenues, 15% growth attributed to that. Moving on to regeneration, accounting for 26 of the group revenues, a tick up from 25 on the same period last year, with growth of 8%. And where the shortfall has really come in terms of that revenue growth has been renewables, which is down to 3.87 in the period from 6.29. We alluded to administrative bottlenecks in terms of our clients that have held some of the planned works backs. These included Section 20 delays. So Section 20 is where, when there are planned works to be undertaken, a notice is provided to leaseholders. It's a 4 to 6 week timeframe to undertake that. Generally a formality, but it is that time lag. So if there's a delay in that, then you lose time associated with that. Similarly, there's been a chunk of asbestos surveys in some of the service divisions that needed to be undertaken by third parties through the clients. Bottlenecks in that delay our work implementation, because health and safety wise, you need that covered. I'm pleased to say, these got addressed during H1, in the latter part of H1. So these works have now come into play and will certainly feed into that traditional heavier second half weighting that we have seen previously. And we look to see those revenues getting adjusted accordingly as we move into the full year. In terms of service divisions, electrical services, Clive's alluded to, it has been the lead. Total revenues across the three service divisions has increased in terms of the electrical part to 47 in the first half, delivering 20% growth. Again, with new contracts getting mobilised, with some of these delays coming into play, we expect a rebalance. We have the usual matrix that we'll share with you in the presentation to give you a deeper flavour of that. But we expect these three pillars, and certainly the three service divisions as well, to harmonise as we move into the full year. During the whole calendar year, and certainly within the period, a number of successful placements in terms of major frameworks, and with that subsequent direct awards. Again, we'll go into that in more detail during the presentation, but that obviously provides us with a raft of opportunities, both short and near term, for us to capture and maintain our momentum. We've made further strategic investment in terms of the business development team. Got some details on that for you as well in terms of the slides, as well as the renewables team. And this is part and parcel of our strategic investment to execute the initiatives as part of our growth strategy. A satellite office during the period was established in Durham in Norfolk, following strong interest in our services in the east of England, which has resulted in terms of direct awards through frameworks. Again, we'll share more detail on that. And that only serves to further consolidate our strong geographic position. So the final operational highlight to mention is the fact that our Year 2 Carbon Net Zero Strategic Report has been released, and our maiden ESG Impact Report is expected to be published in December 2023. As we've always outlined, ESG and sustainability is at the core and heart of what we do, and it's important to demonstrate that in terms of our actions that the business undertakes as part and parcel of that. We then move into discontinued operations, and I'll pass over to Lee Venables, our COO, who has been working tirelessly and vigorously with the associated team to make some substantial progress on these, and I'll pass over to Lee.
Thank you, David, and good morning to everyone. Pleased now to say that work has progressed substantially on the 7 of the 9 DCV projects that we are on site, and we are still, as I sit here today, on track to have 5 of those 7 completed by the end of this calendar year, so within the next 4 weeks. The final 2 of the 7, we are on site, and we do expect both of those to also be complete within our financial year by the end of March. That then leads us on to the 2 outstanding remaining of the 9. Of one of those, one was the anomaly. So where 8 of the 9 are directly attributed to clients directly, the 9th one was with a house builder, and the house builder then was contracted to the ultimate client. There's been some movement on that one, and that house builder unfortunately entered into administration in October, and that has then led to a terminable event on that contract. So dialogue continues on that, and you'll see on the presentation as a result of that, we've made a small provision of 0.26 million for associated legal fees within our accounts. Of the final one of the 9, we continue to have constructive negotiations with that client, and we are hopeful of getting some sort of resolution on those discussions within this financial year. So across the 9 projects, that has amounted to this 0.46 million provision that we put into the accounts in this period, but real positive movement on the 7 and on the remaining 2. So we're starting to see the light, I think, at the end of the tunnel from that DCB perspective.
Thank you, Lee. Clive, if we move over to financial highlights or financial summary, please.
Yeah, I have just 3 slides really to go through. The first, just income statement slide, 2% up on revenue, but you'll see within there actually, again, just reiterating what I said earlier, really driven by electrical with some small decrease on building services in the period. Again, we're expecting these to rebalance in H2, and mechanical services down 18%, and that's partly driven as well by where we've referenced previously, where we were exiting from a private client. So it's slightly anomalous in terms of our regular sort of client base in terms of sort of social market. So some of these things we're expecting certainly on the revenue side of things to balance out, and certainly the mechanical and the build come through in the second half. And again, there's some slides later on in terms of the awards, and you'll be able to see some of the categorization of those revenues that we're expecting to come through. Gross profit was really good. Margins, as I said, up a couple of percentage points against probably expectations as well. I think our normal expectation on gross profit would be around about 26%, and it's come out at high 27s, so a couple of percentage points. So, and I think we will normalise back to H2 as some of these other elements come through. It's really very much driven by the uplift in the electrical division, which has higher margin historically, and even some of the works within that electrical division were higher margin. So it's a slightly kind of a perfect storm, a good perfect storm, I guess, in that respect. And operating margins, again, you can kind of see that in terms of how that then flows through and the differential between the 3 divisions. So EBITDA up at 2.9 million, 21% up, as I previously referenced. And then below that, I mean, again, the only things that I'd really pull out again was those non-underlying items. It's 55k against over 400,000. And in prior years, the non-underlying items have been driven principally by non-cash amortization of acquisition-related customer relationships, so an intangible asset amortization, which is now fully amortized. So we're only seeing a relatively small non-underlying item now. Tax is at 25% in terms of the tax rate, the new underlying rate, so slightly higher, obviously, percentage rate than we had previously. We more of a cash flow, so we'll be coming onto it, but I'll reference it now anyway, in terms of we haven't had any corporation tax payments in this financial year to date, and we don't expect to. So we had tax losses brought forward. We do have some further tax losses that we're going to be utilising in this financial year, but we are expecting there to be a taxable profit in this financial year. So we are expecting to start to see corporation tax payments coming into FY25. In terms of the discontinued operations, which Lee has spoken about and given an overview on, in terms of cash outflow in the period was 2.6 million. I mean, it's reflective of the progress that's been made on site within those projects, getting them through to completion, to certainly with the 7 of the 9 that are there that are well in progress to close those out by the end of the financial year. So we are seeing a further cash outflow in H2, probably of a comparable amount as in H1, which does bring us over in total of our expected total provision that we have on the cost to complete, which are about 5.7 million after the increase in the provision that we made in the financial year. So we will be ahead of that, and then the cash coming back. Cash is expected to really come back on those accounts in early FY25. And the reason for that and the way that works is with the construction projects, there are retentions, so we get the retention monies back in at the end on final account reconciliation, and to some extent a little bit further out than that as well at the end of defects periods, which will come into FY25. And there's some variations on the projects that will see us coming back to that gross amount of the provision that we're expecting of 5.7 million. So that's the basic profile of where we see the business. In terms of looking at cash from that perspective, a good cash conversion. I mean, it's certainly within the range at 92% that we would be expecting. We have done over the last few years a very, very good cash conversion, but for the nature of the business, we're kind of looking 90% plus is good cash conversion, and we're very robust in our working capital process to try to achieve those levels of return, which we should be able to do within the nature of the business that we have. It would actually have been a little bit higher than that. We actually did have at the year end around about 400,000 of cash that was actually received in advance of any monies being done. So it wasn't even accrued revenue; it was more deferred revenue. So where we actually have undertaken the work, and that's more around our clients wanting to, kind of complete their budgets and the work being done. So from our perspective, we report those revenues in the year that they actually undertake the work. But from a cash perspective, obviously that came in early. If I normalised that, and that was quite unusual, we don't normally get that nowadays in terms of cash coming in advance, we would have been around about 100%. So obviously that had an impact on prior year. So you kind of slightly swings and roundabouts. But I mean, overall, even on the sort of the 18-month period, we would be looking at that 100%. So we're very, very pleased with that. I spoke about the discontinued operations already. And in terms of any other items, I mean, very small item. We are a low capex business. We normally operate at around about 3 to 350k of capex. We anticipate that's into the future that would be comparable. H1 was slightly lower, and that tends to be the case as we do sort of get the investments into H2, generally speaking. And I think that's probably it in terms of the operating cash. Final one, very simple graph, almost just to illustrate that really, and I suppose just to some extent illustrate how the simple nature of the business in terms of we have the net cash coming in from the conversion of the profit, a little bit of interest, a little bit of capex, and obviously the big issue being the discontinued, which as we're starting to get towards the end of that and having, as I alluded to previously, having completed a substantial proportion of those projects in terms of cash perspective at least, that we'll see that gradually being completed and eked away, at least once we sort of start to enter into FY25.
Thank you, Clive. So we move on to the traditional matrix that we provide to provide a deeper flavour in terms of the three service divisions of mechanical, electrical, building services, and the three key pillars in terms of regulation, regeneration, and renewables. As I've already outlined, in terms of the share of the pie amongst those three R's, regulation at 61%, regeneration at 26%, and renewables at 13%. And again, in terms of that share of the pie, mechanical at 20%, electrical up at 47%, and building services at 33%. With a specific reference to the three pillars, compliance and assurance has obviously been the driver to increase that revenue share piece relating to legislation changes, and specifically, I think, driven in part by that Building Safety Act preparation when that comes into effect in terms of 1st of April 24. That has flowed, as we previously showed, in terms of our concentric circle of regulation, regeneration, and renewables. That flows into elements of remedial works that comes off the back of that into regeneration. And then the renewables I've explained previously, but I'll also explain in more detail as we move from the matrix on the left to the matrix on the right. So I've mentioned regulation growth increasing by 15%, regeneration growth 8%, and renewables down quite markedly. But as I've previously alluded, in terms of that, we are very comfortable and confident that that will get addressed in the second half. Part and parcel, as we said earlier, was the bottlenecks that I previously explained. Additional parts of those bottlenecks included one mechanical contract with a client where budgets had been exhausted. The contract was due for renewal in the later part of the year. As a result, they've provided a 2-year extension on that contract, which then brought those budgets back forward, which allowed us then to accelerate our work plans. These are part and parcel of that shortfall, specifically on the mechanical side. Alongside that, Clive had alluded to our exit, which we'd previously mentioned in our full year results in terms of this private client contract. So that has now come to a conclusion. So there will be further drops in terms of that respective revenue in the second half, but that will be covered by new works that we've taken to replace that. Because what I previously mentioned in our last presentation is that we would reallocate the resource associated with that contract to these new contracts, and indeed that's exactly what we have done. So in terms of those three divisions, like I say, there is that shortfall there in renewables. We're comfortable in terms of the rationale attributed to it. We are confident that that will get addressed and rebased in terms of the second half of the year. And clearly, in our minds, this is a strong opportunity for the group, which is part and parcel of the rationale for our investment in that renewables team, which again, I'll go into more detail as we move through the presentation. Moving then, as part and parcel of our investments, we have shared with the market our further investment in terms of our business development team, as well as that renewables team. On that business development team, we've worked very hard, as we previously mentioned, to get the quality library foundation built within the business. As we've previously mentioned, the bid process involves two elements, fundamentally, quality and price. As we've always said, we have strong and stringent expectations in terms of our margin delivery. We are entirely comfortable and confident in the quality of service that we provide, and clearly that comes at a price. So, as we've previously emphasised, when that weighting is heavily weighted on price, more often than not, we will not bother with applying as part of that tender process, because we are not of an interest to chase to the bottom. So where that weighting comes into play on quality, and certainly I think from the sort of council, local authority end, this weighting has rebalanced in recent years, particularly the likes of, sadly, the tragedy of Grenfell. Price and quality needs to come into balance, because whilst you may get things cheaper, the quality needs to come first and foremost. So there's very much a focus for us on that quality piece. And again, I've got a slide on that will go into more detail. As a result of that, we've gained a number of significant contract wins in the calendar year. What we've put on the slide is a focus in terms of the framework wins that have been awarded within the financial year. Now, I want to make sure that this is clear in terms of our positioning with regards to frameworks. Frameworks are clearly fundamentally important because you get a place within the framework. The benefit for clients is that they can save procurement costs and they can save time by providing a direct award through that framework. However, from our perspective, we account for no revenues within our visible revenue outlook in association with frameworks, because whilst the framework may be worth a potential value of X million, until you get a direct award, that remains as potential. So I've emphasized it before and I'll emphasize it again. We account for nothing in terms of these framework wins within our visible revenues. And alongside that, as I say, as we get direct awards through these frameworks, that is the time then that we put on the visible revenues. But I think this is an important piece, bearing in mind, the current economic environment from the council, local authority perspective, the opportunity to save procurement costs, the urgency of time, the frameworks serve well in that regard. So we've made fantastic progress on that, and in turn, already starting to see benefits in terms of direct awards through a number of these frameworks. So I'll go on to the next slide. And again, these were awards that were made in terms of the period from an R&S perspective. And again, I'll provide the opportunity for Lee to discuss these couple of slides with you.
Thank you, David. I mean, it's important to add as well on that business development team. The strengthening of that business development team has really allowed us to look at these multiple new client opportunities that you'll see across these next couple of slides. Historically, we was very good at looking at our renewals. Unfortunately, with that, you tend to kind of stand still. So certainly over the last 12 months, we've really diversified our client base. And you'll see on some of these, and I'll talk a little bit more in detail, lots of these are related to the East of England area, and we have a slide coming up as we move forward into this new office area. David touched on the frameworks. Placing on the framework is not necessarily important, and I think there's been a lot of work done from a business development and a marketing perspective to really put the focus on who are KINOVO, who are the subsids, what can they deliver, and how can they deliver it. And I think testament to that is this ream of new clients. A good example of that positioning on a framework, I mean, I'll reference that the Greener Futures framework was on the previous slide, and I think it comes up on the next one. We finished 5th out of 6 on the framework, yet we've got a direct award for 18 months work of 4.8 million on the retrofit works down in Chichester. You will notice on this slide, there's lots of trials, 7 months. The reason for this is that's a new area that we're moving into in the East of England via the Eastern Procurement Framework. These opportunities are almost a try before you buy. It allows us to grow into that region and really move us in that operational gearing and our geographical footprint. From a footprint perspective, we do not put engineers on a contract by contract basis. They're very much a geographical scheduling of their work, so that if 2 contracts and clients are next door to each other, there's not 2 engineers turning up. It really helps us with that efficiency and productivity from our engineer base, which allows the margins and the numbers to move. So Going back to some of these short-term contracts, we're waiting for some awards through this asset improvement sustainability framework via the Eastern procurement. And lots of these clients have said, what we'll do is we'll put short-term contracts in place that take you through this financial year, and then we'll look to lengthen those as we go into FY25. Another important point on some of these frameworks, while some of the frameworks are only 4 years, clients do have the ability to award up to 10 years contracts within those 4-year periods. So we could get to the end of that 4-year and someone will potentially give us a 10-year contract. So there's been a lot of work in-house and externally to move the dial forward on some of these clients, and I think that's really starting to bear fruit in the clients that you see. I'll click that. I mean, there's some more examples there. You know, you can see lots of this new work, new clients, and there's been that real change in approach and direction on just maintaining what we've done. You know, we're now starting to see some of these growth opportunities in there. And if I refer back to the matrix, you know, you will have seen the mechanical and the building services were down on previous year. If you look at a lot of these awards that we've got on these 2 slides, it starts to fill the gaps now in on the mechanical and those building services provisions. Importantly, a lot of this retrofit fabric first element is complementary to the 3 divisions. So while they're branded as building services, clearly you can't put an air source heat pump in if the windows and the insulation and the doors are hanging off, because it's a complete waste of time. So it's allowed us really to do this one-stop shop where we've got the electrical, the mechanical, and that building services division, and offer that provision for clients as we move forward. And that's really coming to the fore, as you can see on some of these awards.
Thank you, Lee. We'll move on into a little bit more detail in terms of the tender process, but just again to pick up on a couple of key points that Lee mentioned. One is the diversity of these wins, and with that feed into our pipeline, but alongside that diversity in terms of that client base. You know, in terms of new client growth, I think it's running at 20% in terms of the portfolio plus. And we will continue. You know, this is part and parcel of our strategic objectives. One is that accelerating organic growth. The other side then is that consolidation in terms of our geographic footprint. And these bid wins feed into both of those, because the organic growth acceleration speaks for itself. As part of that geographic consolidation, by diversifying that client base, we start to consolidate that footprint. And through that consolidation of footprint comes back to Lee's comment that we can continue to maximize and optimize the productivity of the workforce. And that's where that operational gearing and operational efficiency continues to improve as a result of that. Moving then into the bid perspective, wanted to provide a little bit more flavour in terms of our bid wins, bid process, you know, improving our collaborative support functions. These bids work cross subsids, and strengthening that is fundamental as part of that outlook process. If we look at a November to November time period, you know, we've won 16 tenders as such, which includes the framework process, with attributable revenues 44 million. What we've not won is 15, attributed to about 51, 52. So when you look at our strike rate, you know, it's fundamentally 52% of tenders bids and 49% of the value attributable within that portfolio. There are still 21 tendered projects that we are awaiting results on, amounting to the tune of 72, 73 million. With respect to the bid wins and the strike rate, you know, I need to balance that out with the perspective that, one, we are very selective in terms of our bid process in the first place. So if we were to look at the number of bids that we applied for, should we say, in terms of 52 versus the amount that we've turned down, it would be disproportionate in terms of what we've turned away versus what we've bid for. part and parcel of that goes into that price quality weighting, and that focus that we want to drive in terms of our key service offerings and service deliverables. In terms of strike rate, again, I want to also balance that. Clearly we could improve strike rate, but if you're driven on a strike rate, which we're not, this is just part of our assessment in terms of measurement and management. But once you get down that avenue, you potentially start to chase revenues, and we will not be chasing revenues in terms of our bid process. And I'll come back to that as part and parcel of that side on the right. So our average annual value in terms of the bid process and our average term has shrunk slightly. I mean, we're certainly more interested in long-term contracts, 3 to 5 years plus. The average term has crept back a little bit to 24 months, and the average value is reduced. But that is fed by the previous transparency you've seen in the previous slides with regards to some of these short-term projects, with a view and expectation actually that they will convert into larger direct awards as part and parcel of that process. So focus remains on longer term contracts, like I said, 3 years plus. In terms of strike rate, positive, but I pay less attention to that for the reasons I've explained. What I do pay attention to is that block on the right. When I talk about the business team investment, we've got the basis and we've got that momentum. Clearly, the more in terms of bids applied for, the potential for more out. What this will not be sacrificed for, of course, is like I said, we want to focus on quality as opposed to quantity. So these additional investments actually are to give us more time to ensure we have full attention in terms of the bids applied for, in addressing our position to demonstrate that quality perspective. And with that, we want that quality of bid to increase that success rate, not the quantity of bids. Margin management is critical for us. We don't compromise on that. We are confident we provide a quality service. That quality service comes at a price. And more often than not, when we win these bids, we are never first on price. Potentially second, third, plus where we stand out is on that quality perspective, and that is the objective for us to drive through. And then in turn, again, as we're pricing these perspectives, we don't take account on those operational efficiencies, which should provide us with further uplift opportunities as we enter through that bid process. Digging this into, there's an element of a cut and paste on this slide, so please ignore the majority of this because it repeats the previous. The key thing here was to provide some flavour on the two pie charts on the right-hand side. Again, over the last 12 months, this gives you a breakdown of the bids and the related service divisions that they associate with, and alongside that, the associated values that are attributed to those bids that we have approached. Within that process, it is to demonstrate the diversification of our approach to focus on our three service divisions. You'll see one block there, which is retrofit, and that retrofit will encompass, obviously, a variety of the service divisions by default. And that plays into Lee's comment of our strengths of a one-stop shop with respect to all our service divisions, covering elements of that retrofit piece and the associated accreditations that we have with that.
David, I think it's also important to add that on the bids, whilst we get feedback on the ones we win, we also get feedback on the ones we lose. And perversely, sometimes you can learn more from the ones you lose than the ones that you win. And there's been lots of innovative stuff that we've brought into that support function that we now have implemented. So I'll give an example. We've now brought in something we call Find My Engineer.
You mentioned that at the full year, Lee, didn't we? Yeah. Amazon-esque
type. You know, that's as a result of some of these lessons learned that we've got in this feedback. And I think it's important that we keep moving forward, because if we don't, we very, very quickly go backwards. So it is fundamental that those lessons learned continue, and we use those learnings to improve as we move forward.
Thank you, Lee. On the subject of bids, and one thing that we'd alluded to previously, but is relevant as we move into the next slide in terms of another strategic initiative of ours in terms of investing in our people and our communities, is social value. We mentioned quality and we mentioned price as part of the parameters of measurement within the bid process. Another one within that mix, which I have mentioned before, comes out of a government policy procurement note, PPN 0620, where 10% of bids in terms of their measurement should be determined by the social value contribution of the organisation. There is a potential expectation that this moves to 20%. I'm pleased and proud to say that social value is important to us regardless of that bid process. And this is something as an organisation we're committed to undertake internally and externally. The added value benefit of that is that in turn will play into our bid process as part and parcel of that. A number of key drivers here. I think the slide says it all. The points I would emphasise is the amount of in-house training hours that delivered. As we've said before, our engineers are fundamental and important to us as part and parcel of that front end. Whilst we want to drive that productivity and efficiency, I've mentioned previously, part of that scoping is broadening that skill base within the engineers we had. And we've invested a lot of time to create value for those engineers from a personal and professional development by broadening their training and skill base. Alongside that, we've increased the apprenticeships with 9 apprentices created during the period and 3 apprenticeships being completed within the period. Again, I referred to this previously, but there is an aging workforce in terms of that engineer operative base, and it's fundamentally important that we keep that pipeline moving. We provide clarity of potential for these engineers and operatives to develop their career in whatever manner they want, and with that we continue to expand that workforce. So here is a snapshot of that and deliverables within the period with regards to our investment in terms of our own people as well as our communities. Alongside this is just a snapshot of some of the works that we've undertaken to give back to the communities that we work in. I think on one side, in terms of the culture of the business, is to understand the client base that we represent and the responsibility we have to that. And alongside that, the mindset of being able to give something back. And along with that, undertaking activities that help us with our own mental health and well-being. So here are a variety of things that have been undertaken within the period, whether it's a ultra challenge walk, within that working in a soup kitchen to prepare meals for local residents, helping out in a play centre and providing a refurbishment of a sheltered housing lady for domestic, a sheltered housing unit for domestic abuse, alongside nature trails, a whole host of things that we undertake as part of our volunteering process that we proactively engage, and all the staff have at least one day a year in terms of a commitment to helping the community and provide something back, and it's something we're very proud of. Moving on then, in terms of the further 2 strategic initiatives, expanding our core competencies and consolidating our geographic position. We have obviously alluded to that investment in the renewables team, and we alluded to settling up the satellite office in terms of Norfolk. Lee, perhaps you want to provide some more detail in terms of that.
Yeah, I mean, so really, why Norfolk? Fundamentally driven by, as David said, the investment in this retrofit team, and our retrofit assessor coordinator lead lives in the Norfolk area. That's one reason. The second reason was really this Eastern procurement framework that we got onto, because there are 24 members within that Eastern procurement are in that Norfolk, Suffolk, Hertfordshire region, and talking to those guys in the framework and that run it, said that not many contractors have got a base in the heart of the Norfolk region, and to really emphasise that growth opportunity in this region, we suggest you get a base. And Interim is right in the heart of that vicinity. It's a satellite office, so very low cost base, but it really fills into this renewables expansion from this social housing decarb, this home upgrade grant funding. And the team, perversely, some of the team were already working in and around that area. You know, we have other contracts with our subsidies, so we've got an engineer base in the region. So it's really allowed us to, from that accreditation piece, and we've been quite vocal on, we had the electrical and mechanical and now the building services. It's allowed us really to grow into this area. And if we revert back to some of the previous slides on them awards, you would have noticed that there was a Norwich City Services, there was a Great Yarmouth, there was a Saffron, there was a Broadland. Those opportunities have come off the back of a launch that Eastern Procurement did on this asset improvement sustainability framework that we've got on in that region. And that's borne fruit now really out of that. Next week, we do an official launch of that office. I think it's the 5th of December. So I'll go up. I think David's coming up and a number of the other senior people across the business. And we have officially invited all 24 members from in that region to come and see the office, to see what we've done and show them what we can do. You know, when we were talking to them at the recent launch, lots of contractors in the region had almost got a little bit complacent because I can do mechanical work, but I don't want to do this, I don't want to do that. Well, we'll do it all. You know, give us some small opportunities. Let us show you what we can do, and it will really allow us, because what we don't want to do is go and grab everything at once and fall over, because we're born out of the quality of our service. So let us grow into this, and this next 4 to 5 months up to the year end will really allow us to improve the team with a big recruitment drive in the local area. We talk about the social value element of it. There's a recruitment there also being driven out of that launch, where we've invited one of the local councils and their recruitment advisors. So it's really now a base for us to push on and capitalise on the underperformance of our competitors in the area, and show that this one-stop shop can really start to move us forward in this area. And I said this previously in one of our presentations yesterday. We can get to our Interim office from head office in an hour and a half, 2 hours. Sometimes it can take me longer to go from our head office to our Hackney office, which is 12 miles down the road in the traffic. So it's opened that corridor up there. There's other councils in between. It's allowed opportunities for us to now tender in those regions between the head office and the Interim office. And it's really opened up that geographical footprint that we're moving into.
And I think that you know, that's the key point that Lee makes. One, we're already working in these areas anyway. Two, being at the heart of it has already demonstrated its value through some of these direct awards. And by having that geographic outlet, it does indeed allow us to consolidate our geographic position, because again, as part of that acceleration of organic growth, you know, by being in Durham, it makes that Cambridge Council application, for example, if there's a tender, much more approachable, because we're in the area and we're in the region as such. So, you know, there is multiple benefits that come off establishing that satellite office. And again, we're starting to see the depth and breadth of our accreditations and this one-stop shop positioning in terms of the business provide these competitive advantages to put us at the forefront in terms of these opportunities. Thank you, Nick. So this is the final slide. And I think, you know, in terms of where we're sitting here, we are in an inflection point in terms of the business and where we're at. And I mean that from a positive inflection point. You know, we've had a positive start to the second half of the year. Momentum is increasing. The delayed works we mentioned is catching up. Mobilisation of new works are in play. And that traditional heavier second half weighting is expected by the board in terms of the full year perspective. ongoing execution of strategic initiatives continue to strengthen our position and create opportunities for all service divisions. Hopefully, as you've seen through the presentation, that there has been a clear deliverable from what we say is our strategy, what are the initiatives within the strategy, and the ongoing execution of those initiatives. I think that is a critical path that hopefully is very evident in terms of the presentation. In terms of where the business is, the resilience and robustness of the business has not only been evident in terms of the ongoing management of the DCB projects whilst we continue our business, and with that forward view of 157 million of 3-year visible revenues, 95% of these being recurring, 66 million of these visible revenues being anticipated to be recognised in terms of the full year 24, and a continued robust pipeline of opportunities in terms of further contract wins and awards as well under those frameworks. In terms of DCB, Lee had covered obviously our positioning on that, and that plays heavily into our inflection point. 5 of the 9 will be completed in December, and at least 2 more being completed in terms of the financial year end. So from where we sit as a board, we're very positive, very confident. We remain in line with our expectations for the full year, and we are very well positioned, not only to continue our growth trajectory, but to maximise shareholder value creation. Thank you very much.
Perfect. David, Clive, Lee, thank you very much indeed for your presentation this morning. If I may just jump back in there before we look to take the questions. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the team take a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Lee, Clive, David, we did receive a number of pre-submitted questions ahead of today's event, and as you can see, a number of questions throughout your presentation this morning as well. So firstly, thank you to all of those on the call for taking the time to submit their questions. And guys, if I may just hand back to you just to read out those questions and give your responses where it's appropriate to do so, and then I'll pick up from you at the end. Thank you.
Thank you very much. Before I go into the sort of Q&A, I have noted that there were a number of questions in terms of the pre-submitted, obviously in relation to, and understandably in relation to the DCB projects and profile, should we say. I'm hoping that we've covered most of those questions in terms of the information that we've shared within the presentation. However, if there is anything outstanding on those from those potentially pre-submitted, please do feel free to submit those again in terms of additional questions from what we've shared. If I start off with one set here, I've been asked what our opinion would be in terms of how would a Labour government affect the business if they win the next election. From our side, we can only reflect that on history in part. And with that, it's clear in terms of the social housing leaning of a Labour government, and certainly that's been evident in history of the commitment to spend in terms of previous Labour governments. So, in terms of how would that affect the business, certainly I don't expect any negative impacts within that. Because of the nature of the beast. We clearly, our focus is in social housing, is in local councils, local authorities, and Labour have made numerous pledges in terms of their commitments to invest and address some of those issues. So from our perspective as a business in terms of Labour government, there's certainly no downside, should we say, in terms of our expectations should we get that. And if history is to play a part into that, then indeed, there would only be positives to potentially come out of that perspective from a business side. Moving further down, There is a question here. The brokerage report assumes investment and working capital for this and the next financial year 2.2 and 2.7 million. I'm aware of the changed terms on the purchasing card facility and the anticipated cash outflow of 1.4 in May 24. Should we expect further investment in working capital as laid out in the brokerage note, or is it too conservative? Clive?
I think that's one for me. Yeah, I think that's actually. I'm not sure if that's the. I mean, I don't think everybody on this call as well will have access to that brokerage note. So it's quite a specific one in that respect. I mean, what I would kind of say is what we're expecting, and the brokerage note is outlining, is that from a year-end perspective, we're expecting to be in a net cash position. Now, that's probably, sort of in terms of a relatively low amount after we've, as I previously referenced the DCB outflow. We're expecting to be about break even, maybe slightly better than break even, and that's some of the reference in terms of the working capital movements as to how you get to that number. So there's lots of assumptions within that in terms of the FY24 number, the 2.2, but I think that actually has gone down substantially from that number as we've and the broker has updated those notes. I'm not sure on the FY25, but there's reference there into the change on purchasing card facilities, and that certainly has a 1.4 million impact. We didn't mention it earlier. It's in the trading statement, but we are expecting in May 24, as the question refers to, that we are changing with HSBC, who provide the purchasing card to us, a reduction in the credit terms on it, which is a reflection of a change in their standard credit terms, reflecting to increases in base rate that have occurred and the profitability for them on that product. So that's a reflection of changes within the banking community and such like. So that will have an impact as referenced in the trading statement and there in terms of that impact. And then beyond that, working capital change will effectively be around cash conversion. So although we are delivering that high 90s, we normally take an assumption around the 90% in terms of it looking forward. And obviously that is the broker's note, not our notes. So, but that's in line with what we expect. So rather than talking about the specifics of the numbers there, in terms of the profile, certainly FY25, there is a bigger working capital movement, and quite substantially bigger because of the purchasing card change in terms.
Thank you, Clive. Another question here. Last year, you alluded to strategic initiatives. What is the status quo on these? Well, hopefully, obviously, within the presentation and the detail we've given in terms of the execution of numerous initiatives in line with what we've clarified are the drivers behind our growth strategy. Hopefully that answer has been provided. If not, again, please ask a further question on that. There is a question here which I think has been a misinterpretation, but increased gross margin due to lower non-underlying costs. Which non-underlying costs have previously been recognised at this level? Clive?
Yeah, I mean, I think to be fair to the question, actually, I think there's a slight typo in the interim statement in terms of that. So there aren't any non-underlying costs in the gross margin. That was more referencing at operating profit level. So apologies for that. So I think that answers it. So that there aren't any. It was more a reference to operating profit level, which goes back to some of the discussion we had earlier in terms of the reduction in the non-underlying costs and the rationale for that.
Question here, which I think has been answered. As far as I understand, you win a framework, which means that KINOVO will be included in future frameworks, which will then lead to contract wins, followed by an increase in top line. You've announced many framework wins so far. Those should materialise in the future and not immediately, which makes me think we'll see an increase in revenue. Is my understanding correct? What is the usual timeline for framework to contract wins and start of contract? I think, again, hopefully we've covered that question within the presentation, and therefore that question has been answered. There was a further question here, in that I've seen that Inland Homes went bankrupt and DCB had a contract with them. Which effects will this insolvency trigger? Will there be an option to withdraw from the project entirely? What could be the impact on the provisions? Again, I think we've covered that within the presentation, hopefully as part and parcel of that. Further question here: is it right to assume that if you keep your win rate at 50% and you win 50% of the 72 million with an average of 24 months, this will result in 18 million in revenues per annum? What do I miss here? Well, these are interpretations on interpretations. I mean, one I emphasize that whilst we use those hit rates as just a demonstration in terms of transparency, we don't attribute or make any forward assumptions in terms of those expectations for the reasons we mentioned before. We provide the best quality bid that we can put into play, and when we get awarded the contract, then we'll make that interpretation as such. So in terms of the individual's interpretation, the transparency is there for you to make the calculations, but I would not be in a position to go and provide any interpretation or assumption in terms of what that translates to in terms of an expectation moving forward. Our focus remains on providing the quality within the process, and with that, letting the process take its course.
I think with the reference to the 24 months there is probably would be too short a period in terms of those outstanding tenders anyway. So
agreed, Clive. As we said earlier,
you mentioned that average has been brought down by other factors rather than just the pure tender.
No, that's a great point. I think absolutely. As we've emphasised, we're looking at longer term contracts rather than shorter term contracts, and as Clive quite rightly points out, that is an anomalous blip in terms of expected timeframes for the reason we mentioned in the presentation. Thank you, Clive. It seems that you've exciting times ahead considering the amount of potential opportunities. How do you want to solve the bottleneck of not enough employees? So in terms of the employee base, as you've already seen, we continue to make strategic investments in key areas. I think from a business perspective, we are cost conscious and we want to maximize the efficiency of that cost. So in terms of investments in play, I don't think there's a requirement for game changers per se as we speak. We gain momentum on that bid delivery, so we make further investment to continue that direction of travel. Similarly, on that renewables piece, we've got the accreditations in play. We've got some of these frameworks in play. Let's capitalise on that opportunity in terms of that investment in the team. And I think, again, in terms of our progress and our pathway, we continue to do this self-financing process and object to provide this self-financing process in terms of the business so that it feeds itself. In terms of growth and the outlook on the business, we're very comfortable and confident in that delivery. And certainly we are in a focus on stabilisation and letting the true opportunity and potential of this business come to fruition. And as that is delivering, we will continue to make our investments within that piece. In terms of the front end, we've already emphasised this previously. We have a nice diversity in terms of DLO, direct labour, and with that, subcontractors. Again, there's been a focus to continue to diversify the subcontractor base. One, it increases the resources available, but alongside that ensures that they all keep their pencils sharp and their quality first class in terms of their delivery. And then within our own base, we continue to always look for good employees. We continue to focus on our apprenticeships. You see the progression of these apprenticeships into qualified engineers. And at this stage, we don't see a bottleneck as we are. And as we grow, we'll continue as an ongoing basis to assess that scenario to see the direction of travel and where that takes us. But we're confident in managing that on a self-financing basis.
David, you talk about employees. I think it's also important that we're not just going to go and get the next one on the shelf. There's a culture that we're creating within the business, and it's important that any new employees fit into that culture and sharing our values as we move forward. And you touch on apprentices, that pipeline is still there. 14% of our employees are apprentices, and we continue to invest in that stream.
Absolutely. Thank you, Lee. There is a question here. Please explain in more detail what the implications are of the building partner going into liquidation on one or two remaining unresolved DCP construction projects. Also, is KINOVO liability on the second unresolved contract limited to the amount of the 860 performance bond? Lee, do you want to answer that?
Yeah, I mean, I think
we've covered, I think, point one anyway.
I think point one we covered, that we obviously see it as a terminable event. In relation to the second unresolved one, yes, that performance bond is still in place. And at this stage, we are in constructive negotiations with that employer, and we hope to get a resolution on that soon. So I think that's all I can really say on that at this stage.
Yeah. Okay. Thank you, Lee. The final question that we have: SureServe, a competitor of KINOVO, was taken over earlier this year at PE 13.9 historic EPS, which would equate to a share price of 94p for KINOVO on historic EPS 6.76. KINOVO share price 50p, so DCP situation is weighing heavily on KINOVO. How can we be sure that the 5 million contract shortfall is going to be the final liability, and how is KINOVO financing this? I mean, in terms of the financing, we've been financing this through cash flow. I think that's been evident in terms of the numbers that we've shared, as well as the remaining outlook in terms of the second half of the year. So hopefully we cover that. In terms of how can we be sure that the 5 million contract shortfall is going to be the final liability? Well, of course, you know, being entirely open in that perspective, that the final liability will be once these final liabilities are addressed in terms of all these projects. I mean, in terms of what we've got from an optics perspective and where we are on that, we've been entirely open in the market in terms of our position and where we expect we are and will be. There's final account reconciliations to come in play, but as and when there is an expectation in terms of any change, clearly we would update the market immediately. I think the perspective needs to come back to the fact that 5 of these 7 projects will be completed in terms of the end of December. The other 2 will be completed by the end of the financial year. We've outlined the position on the 8th, and in terms of the 9th, we're in discussions in that process. And that is the context in terms of closing that process. Clearly starts to strengthen the position in terms of where we will be in terms of that final process. Hopefully that answers that question as well. There is a couple more actually that's come through. Looking forward, looking out a bit further, once you turn net cash, how do you think about capital allocation going forward beyond this point? So our focus is to get in that position. First and foremost, we need to get DCB put to bed. And as I said, we are in this inflection point where we see the light at the end of the tunnel coming relatively quickly. The number one objective, I think, off the back of this, with DCB close, is to demonstrate the true value of this business. And I think one of the key drivers in that is our cash generation. You know, in terms of these elements of darkness that we've had to deal with in history, what is lying underneath that is a resilient, robust, continuing business that generates a lot of cash. So in terms of that outlook and that net cash, you know, the number one thing would be for us to demonstrate that model and provide that trust that this is the amount of cash that this can generate. Within that process, of course, we'll continue to make investments with the business along the lines of the answers I gave previously, strategic investments here and there to ensure that we deliver and drive our organic growth process. Meanwhile, we'll focus on building that cash reserve, because in turn, that cash reserve builds up further the resilience of the business. that cash reserve provides us with further options and opportunities on which is the best direction to deploy and allocate that cash accordingly moving forward. But we're in no panic to be utilizing that cash. The key thing is to be generating it and delivering it and demonstrating that value in the business, because that will reflect by default in terms of the valuation of this business. Once the remaining DCBs, next question, once the remaining DCBs issues have been resolved, do you expect the company will be in a position to start paying a dividend to shareholders? Again, I reflect back to my previous answer on this. I think, let's get into that position and focus now. Let's get this DCB closed. Let's drive some of these initiatives through and let that organic growth be even more transparent, and with that the associated cash generation that comes from that to be evident, and then that consideration can of course come into play as part and parcel of that capital allocation question and our outlook. That covers all the questions.
David, Lee, Clive, absolutely. And thank you very much indeed for being so generous of your time then, addressing all of those questions that came in from investors. And of course, if there are any further questions that do come through, we'll make these available to you immediately after the presentation has ended, just for you to review, to then add any additional responses, of course, where it's appropriate to do so. And we'll publish all those responses on the platform. But David, perhaps before really just looking to redirect those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that would be great.
Thank you very much. No, in terms of closing comments, obviously I thank you to everyone who's either heard this live and or will be watching the recording, to thank you for your time and your interest. And in terms of our current shareholder base, to thank you for your ongoing commitment and support. As I said, I think, from the board's perspective, we're extremely positive, not only in terms of where we are, but more importantly, the outlook. We are at this inflection point of the business, and we're very excited in terms of the outlook for the business, not only for the full year, but more importantly, over and beyond. As usual, as I previously said, I've had the privilege to have numerous discussions, whether it's emails, phone calls, with a wide variety of our shareholders over the recent months. That open door, open invitation remains. Please do not hesitate to get in touch if you want to pick up on anything further in terms of the presentation and or any other information we could provide. And then outside of that, on behalf of the board, we take the opportunity to wish you all and your families a very happy, healthy, festive season. And we look forward to be in touch in some way, shape or form again in due course. Thank you very much.
David, that's great. And thank you once again for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of KINOVO PLC, we would like to thank you for attending today's presentation. That now concludes today's session. So good afternoon to you all.